Hey y'all, welcome to another episode of Tax Facts Friday as we go through Money Matters May. So, just coming off of tax season, last week I wanted to talk about commingling funds. And when I was uploading the video to YouTube, I realized that I talk about commingling funds a lot. And the reason is because it is a recurring issue every single year, all the time. People want to mix personal transactions with business transactions. And I talk about it for a number of reasons, but the main reason is because the IRS requires you to keep your business transactions separate from your personal transactions. You need to have a separate bank account for your business and your personal stuff. The IRS requires you to keep accurate books and records. If you are a business owner, you need to keep accurate books and records. And two, you cannot file a complete and accurate return without good organized records. And the third, you can't properly tax plan. A lot of people come with, receipts and, a spreadsheet that may not be all the way put together. But when we are looking at tax planning, we need to see that balance sheet and that profit and loss statement and the cash flow statement. You want to know how much money is going in and out of your account each month, each quarter, each year, especially for tax time and business continuity purposes. You want to make sure that your business is operating at its max successfully. So, with that, this week, want to take it a step further. We're gonna leave, commingling alone. I think you all get it now. It's important to separate your business and your personal transactions. This week, I want to talk about the DIY, the do-it-yourself, and when you DIY it wrong. A lot of people, want to save money. You want to save money and try to do things on their own. But my question to you is, if you broke your toe, are you going to perform the surgery on your toe? Are you going to prescribe your own medicine if you're feeling ill? No, you're going to go to the doctor. You're going to go to the specialist. You're going to go to the expert who can do things properly. Because what happens is when you try to do things on your own, you wasted time, you wasted money, or time that you could have used to make money. And then when it's time for us to correct it, either you're going to have to go back and do it all over again, or you're going to have to pay more to have it corrected than you would have had you gotten it done right the first time. But before I get into that, I want to introduce myself. My name is Caritza Kearns, and I am the owner of K&K Tax and Accounting Services. I'm an enrolled agent and certified tax coach. I study all things taxes. I absolutely love taxes because that taxes and knowing how to avoid them is one of the key ways that can help you build wealth. We talk about generational wealth all the time, but if we are giving the IRS the majority of the money that we make throughout the year, that's going to delay our wealth and the wealth that we can pass down to our kids and grandkids and their kids and grandkids and stuff like that. So, with that being said, this week I want to talk about doing DIY and DIYing it wrong. So, like I said, a lot of people, want to save money and try to do things themselves. And the main thing is, QuickBooks. They say, Caritza, I got QuickBooks, so I can do my own bookkeeping. I just need you to tell me, what tax strategies and things I need to put in place. Bookkeeping is easy. I can do the bookkeeping. Well, the truth of the matter is, categorizing transactions may be easy. If you're just looking at it from a task perspective, this is something I have to do, then that part may be easy. However, in order to have accurate books and records, you have to actually know what you're doing. You have to understand tax and accounting laws and principles and things like that. Because what happens is when I look at balance sheets and profit and loss statements from people who try to DIY and they don't have any type of concept or understanding of tax and accounting, your balance sheet and your profit and loss is just wrong. Like, it's all out of whack. Not because you didn't do a good job categorizing transactions, it's because you didn't understand how things are supposed to flow from the bank account to the balance sheet or the profit and loss statement. I see, quite a few things that are wrong on the balance sheet, like car payments and stuff like that. That's just a prime example. If you purchase a vehicle and you finance it, that's an asset. That asset goes on the balance sheet to, track your depreciation, things like that. And the loan amount, that also goes on the balance sheet. The loan is a liability. Now, when you make the payments for the loan and they come through the bank, then that payment is applied to the principal amount of the loan. However, the finance charge or the interest is a tax deduction. So you have to split that transaction out and apply the principal to the balance of the loan and deduct the interest as an expense. You see how complicated that can be? It's not as straightforward as you would think it is. So that's one of the common things that I see come through on the profit and loss statement. I see tax liabilities, like if you owed North Carolina or the IRS $5,000 last year and you paid that out of your business account, you deduct that as a tax expense. That is not a tax deduction. You should not be deducting your tax liabilities that you pay on your profit and loss statement. So when we see those DIY profit and loss statements, we have to figure out, okay, so what's deductible, what's not deductible, what is this? We have to spend time going through the profit and loss statement to determine what you did, what you didn't do, what's the right way to do it. And then it gets confusing at tax time. When you looking at your Schedule C, the profit and loss for a business, you're often wondering, why doesn't this line up with the profit and loss that I gave you? Why is my taxable income higher on my tax return than what I have on my profit and loss statement? It's because your profit and loss statement was wrong. Now, there are some other factors that can go in there that would not be on the balance sheet or the profit and loss statement, that would not be on there. But for the most part, like mileage, that's an example. That's a deduction that's not going to be in your profit and loss statement, but it's going to be on your Schedule C, profit and loss for a business form when you file. But that's just one example. The key is knowing what transactions flow to the balance sheet, the profit and loss statement, and things like that. So I know a lot of times you think you're saving money when you DIY, do it yourself, but you could actually be costing yourself money when you do it wrong. So I want you to take into consideration, what are your skill sets? What are you really, really good at? What are your money generating activities? Because if you spent more time focusing on your money generating activities, you can generate the income that could allow you to pay an accountant to, if you can't, if you're not ready to hire on an accountant full time, you would at least be able to consult with one. Have one look at your QuickBooks reports at least on a quarterly basis, so that you'll know that you're on the right track. You want to reconcile what's in your QuickBooks to your bank account, not at year end, because a lot of times you forget what those transactions are. You want to reconcile everything with your bank account and your QuickBooks at least quarterly. You want to speak to an accountant at least quarterly. Look at your tax liability. Make sure that your QuickBooks are set up correctly. You got everything flowing to the proper bucket, and that will make tax time a whole lot easier on you. Everything is not designed to be DIY. I'm telling you, like QuickBooks, it's a user-friendly tool. I love it because it's all in one. But one of the things that we used to say in corporate when I worked in payroll, you put garbage in, you're gonna get garbage out. So if you don't know what you're doing and what's going in QuickBooks, then you're not gonna know and understand, what's coming out, or what comes out is not gonna make sense, especially from an accountant's mind and perspective. So I just want to end this on a note to say it's okay. When you start out, you want to save money, as much as possible. But when you start producing, you want to make sure that you are investing in your business, investing in a good accountant that's going to educate you, not just at tax time, because at that point it's a little too late, a day late and a dollar short. But you want to make sure that you understand what's going on with your business throughout the year. And that way you can take a proactive approach, which I love. That is my favorite, being proactive and planning, so that you're not overpaying the IRS. No one wants to give the IRS more than they have to. And keeping good books and records, again, which the IRS requires anyway, is one of the ways to stay on top of your finances and pay the least amount in taxes. So I am going to end on that note. Thank you all for joining and watching tonight. Drop a comment or your question or anything like that. Just let me know, if these are helpful. And if you have questions and you drop them here in the comment section, they may be answered on the next coming episode next week or the following week. But stay tuned. I'm going to be here every week with you. If not, I'll let you know. To make sure that we are not just waiting until tax time to ask the questions, to try to gather everything, but planning throughout the year to make sure that we are prepared at tax time. So on that note, I'm going to say good night. I hope you all have a wonderful weekend, and I'll see you next week.